Hey, this is Alex Astley, and it's episode number 125 of Money Hacks. And today I want to talk about taxes. Not necessarily filing your taxes, I'm not a CPA, but more so talking about the tax treatment of your investments. So, as most investors know or have heard us talk about, one of the biggest benefits of 401k accounts, 403bs, even individual retirement accounts, IRAs, is that there are some tax incentivized or tax advantage ways to save and accumulate money for your long-term financial goals in your retirement. The most traditional of that is a 401k pre-tax contribution, meaning the money that you're putting into your 401k goes in pre-tax, before taxes. So it reduces your taxable income this year, lowering the taxes you pay in the current year, and then that money accumulates and grows tax deferred. In retirement, when you take the money out, you pay taxes at ordinary income on the money. So whatever money you pull out from that 401k, along with other income that you might have that's earned taxable income, becomes your taxable income for that year, and you pay tax on the allocable tax brackets within that year that you're pulling the money out. Of course, over the recent years, going back probably 10 plus years, but certainly in the last few years, Roth investments have become more prominent and popular in 401k plans. Now, there's still floating around a little bit of a myth about Roth 401ks that I want to dispel, and that's the fact that if you want to save in a Roth basis in your 401k, anybody can do that, regardless of income. Roth IRAs, which are Roth-related individual retirement accounts, have certain income limitations. Once you earn over a certain amount of money as a single tax filer or married filing jointly, you're no longer able to participate in a Roth IRA. However, that does not exist in a 401k. Anybody can contribute to the 401k on a Roth basis as part of that overall limit of how much money can go into a 401k plan. The benefit of Roth is that, yes, you pay tax today, so you're not getting any tax benefit today, but all the growth and accumulation is tax deferred. And when you take the money out in retirement, as long as you've had that account open for 5 years, it's all tax free. So from a retirement plan perspective, those are two of the different buckets or levers that you have with taxes. And your individual situation may vary on which one makes sense for you. But one of the things we think is really beneficial for investors is to have money that has different tax status or tax treatment in retirement so that you can be strategic in how you pull that money out of your various accounts when you're in retirement to keep your taxable income and tax bracket as low as possible. Now there's another piece to this, and that's non-retirement accounts. So if you're also saving outside of your 401k in a brokerage account or a non-retirement investment account, the money you put into that account is of course money you've earned, you've already paid tax on, and then you invest it into various vehicles like stocks, bonds, mutual funds, or exchange traded funds as an example. As that money is invested and it grows and accumulates, you don't pay any taxes on it until you realize your gain or loss in that investment, meaning you've sold the investment. So for simplicity, if you buy a stock or a mutual fund and you own it over the course of 5 years and it goes up in value over that period, the difference between what you bought it at and the value of it is your gain. And you are taxed on that gain when you sell that investment. Now, there are other things like dividend payments and capital gains payments out of mutual funds. I don't want to get into those details necessarily, but what I want to explain is that when you hold an investment inside of a non-retirement account for more than a year, any gains that you have when you eventually sell that investment, whether it's 13 months or 13 years later, gets taxed at the capital gains tax bracket. Today, in the current tax law, this is a much lower tax bracket than ordinary income. Capital gains brackets are broken into 0% up to a maximum right now of 20%. And so it's a very efficient and tax efficient way to grow and accumulate investments outside of your 401k that are going to generally be taxed at a lower level than your pre-tax employer contributions in retirement. Of course, brokerage accounts, you have the benefit that you can take that money out at any point in time, so much more flexibility, whereas the retirement accounts that have greater tax incentive, arguably, you're restricted that you can only pull that money out once you get to retirement age. Hope this is a good primer on how the tax treatment of your various investments works. There's much more to it than this, but this is a high-level overview that ideally gets you pushed in the right direction when you think about your overall retirement savings. Thanks. See you next time.